Hello, I'm Nadia Daly. Welcome to Close of Business. Coming up on the program, Qantas profit and dividends flying high as travellers hope the Qatar Virgin deal means cheaper flights.
We need competition. I mean, Virgin and Qantas have literally ruled the skies for years now.
Yeah, competition's good. I mean, yeah, definitely.
And Woolworths wields the razor, slashing $400 million in costs to return to growth.
At the moment, we're very focused on making sure that our customers can get value when they're shopping at Woolworths.
Also on the program, Microsoft accused of trapping its customers into paying high subscription fees.
Well, I don't know whether it's fraudulent, but it's certainly misleading.
But first, passenger numbers are up, and so is revenue, as the flying kangaroo rewarded investors with their first post-pandemic dividend. The healthy result was boosted by a surge in low-cost travel, Jetstar earnings jumping by a third. The result comes as the federal government gave the green light for Qatar Airways to take a 25% stake in Virgin, a deal that could see cheaper flights. Rihanna Whitson reports.
It was supposed to be a day for Qantas to spruik its good fortunes and new planes.
Our first Qantas A321XLR will arrive in June, and that will restart the replacement of our 737 fleet.
The airline announced a 6% rise in half-year profit to $923 million, partly due to a 10% increase in Qantas and Jetstar customers. But it was news about the airline's competitors that captured headlines.
I have now approved the Qatar 25% stake in Virgin Australia. It will mean more flights for Australians, more competition in the sector.
The market dominance of Qantas is set to be challenged by the approval of the Virgin Qatar deal. It'll mean more international flights, and consumers will be hoping that leads to lower prices. There'll be 28 new return flights per week from Sydney, Brisbane, Perth and Melbourne to Doha. 3 of these routes will start in June, while flights from Melbourne will begin in December. In 2023, the federal government rejected Qatar's solo bid to increase flights after 5 Australian women were strip-searched in Doha. Qantas also lobbied against the proposal. It's now welcoming the new competition.
We always said that we weren't going to oppose the result. So from the outset, that's been our position.
This is a step to a real two strong airlines competing against one another,
which should push airfares down.
Strikes and the cost of living crunch have put Woolworths under pressure. The supermarket giant has swung back to profit, but the announcement of a $400 million cost-cutting plan failed to impress investors. In a moment, we'll hear from their CEO, Amanda Bardwell. But first, another report from Rihanna Whitson.
Australia's largest supermarket chain is back in the black. Woolworths' return to profit isn't a shock to these customers.
You're seeing a lot of simple things like fruit and vegetables are just getting more and more expensive.
All businesses deserve to make a profit as long as it's not at the cost unethically of the consumer.
The boss of the supermarket says prices are coming down.
Our average selling prices are lower than the prior year for 4 quarters in a row.
Woolworths' profit came in at $739 million for the 6 months to January 5, after posting a $781 million loss the year before. But its food margin was squeezed, down 32 basis points because of higher meat costs, more discounts and customers buying cheaper items. Sales would have been higher if not for strikes at its distribution centres, costing the business $240 million.
It's very aggressive oligopolistic pricing power, so those margins are falling, but one would say probably not falling fast enough, and all those margins are still quite high relative to their peers offshore.
Every country has a different economic setting, different wage rates, and so I wouldn't want to, create direct comparisons in international global benchmarks there.
Woolworths will cut $400 million in costs, meaning some office jobs will go. And like Coles, it's also slashing the number of products it sells.
With both the major players, Coles and Woolworths, the expansion of the home brands is going to continue to increase. That is where they can maintain the margins that they're after to deliver for their shareholders.
Together, Woolworths and Coles account for about 67% of supermarket retail sales. The ACCC is investigating that market power and is due to hand its final report to the federal government any day now. The watchdog has also taken Coles and Woolworths to court, alleging the pair have engaged in misleading and deceptive practices for inflating the price of hundreds of grocery items before advertising them as discounted. Food prices were one of the biggest contributors to inflation in the year to January, up 3.3%, driven by higher costs for fruit, vegetables, meat and seafood. That compares to headline inflation, which remained steady at 2.5%. Former ACCC boss Graham Samuel says he's yet to see evidence of the supermarket's price gouging.
What's the ultimate solution? Greater competition. And the greater competition is coming from Aldi. It's coming from a revitalised IGA, but they're very, very limited in the way that they can offer price competition. And Costco and now Amazon.
Outside Coles, this customer says shopping elsewhere isn't always easy.
It's very hard because at the end of a 2 week I would always have money left over, but now I've got nothing much left over.
While consumers feel the pinch, analysts expect Coles to post stronger half-year profits than its competitor.
Always profits over people, really, and that's something that's concerning.
Things are getting more and more expensive, and then politicians are saying they're going to do something about it, and who knows what's happening.
A call for grocery price relief as a federal election looms.
And I spoke to Amanda Bardwell after she announced her first full results since she began as Woolworths CEO last September. Amanda Bardwell, thank you for speaking to the business. So back in the black for Woolworths with net profit, though underlying profit was down. Been a tumultuous year for the company with the industrial action, leaving shelves bare and lead up to Christmas. How much did those strikes impact the financial results?
We called out today that there has been an impact from the industrial action that occurred in December, and we announced those specific numbers today. What we were focused on is recovering from that as quickly as possible for our customers. It was Christmas time, of course, so it's really important that we're able to get those products back on the shelves for our customers. And pleasingly, we were able to do that, and we've seen an increasing recovery in 2025.
You took over from Brad Banducci a few months ago in a bit of a storm of scrutiny. At the same time, Woolworths has gone from one of Australia's most trusted brands to one of the least. I have no doubt that you hope to win back that trust. Do you feel you've succeeded?
We've got work to do in terms of continuing to see our customers advocate for our brand and to continue to improve our reputation. I think that's very clear, and we're determined to do that. At the moment, we're very focused on making sure that our customers can get value when they're shopping at Woolworths, and value is everything to do with absolutely price and promotions, but it's also about our range, availability and our convenient e-commerce services as well.
How do you plan on defending the ACCC federal court action of allegations that you misled customers?
We don't agree that we in any way have misled customers, and that matter is before the courts, and so I'd let that matter play out in the courts, but we're very clear that there wasn't any misleading of customers from that perspective.
With the $400 million cost-cutting measures we've spoken about today, how many jobs are expected to go as part of that?
What we announced today is a focus on simplifying the way that we work, and in particular looking at key cost lines across our above support areas, so key cost expenses, and looking for opportunities to reduce those. We have also announced the fact that we will be simplifying our support office. It's a combination of those two things that contribute to our savings.
And do you know how many jobs will go as a result of that?
It's a combination of the cost savings that we're looking at in those key cost lines, and then there will be, regrettably, some of our office roles which will go. We have not set a target on that.
In terms of the reduction of products, how many can we expect to disappear from shelves? And is it following Aldi's strategy a bit in terms of keeping inventory costs low to boost the bottom line?
What we're recognising is that as customer behaviour continues to shift, it's important that we've got the right products available for customers, and so that often means making sure we've got enough product facings on our shelves to hold the volume of stock that customers are wanting. And what we're announcing today is to say a targeted optimisation of that range, just really reflecting the changing customer behaviour that we're seeing and making sure products that customers want are on the shelves. There is no specific target that we've set because of that.
Amanda Bardwell, thank you for speaking to The Business.
Thank you.
Microsoft is facing a customer backlash after jacking up the price of subscriptions for its popular apps, including Word, Outlook and Excel. The company claims the higher prices are justified because of upgraded services and new artificial intelligence features. But users say the tech giant is making it harder for them to opt out. Nassim Kadem reports.
Marie Sellier has a monthly subscription to Microsoft 365, giving her access to popular apps like Outlook and Word. The tech giant then hiked the price, claiming it comes with AI features, and gave her 24 hours to cancel.
I don't know whether it's fraudulent, but it's certainly misleading, because if their terms and conditions say that they will give you at least 2 weeks' notice.
Microsoft says it's investigating the matter, but she says customers should have been asked if they wanted to opt in to the new services.
I'd much rather just have standard offering. I can choose what I want to use. If I want to use AI or any of these other offerings, then I'll choose to increase my spend and change my subscription type.
A personal subscription for Microsoft 365 increased 46% from $109 to $159 per year, or $16 a month, up from $11, while a family subscription jumped from $139 to $179 per year. Lawyers say what Microsoft did should be investigated by Australia's consumer watchdog.
If there's been any misleading conduct, including in terms of omissions of key terms in relation to the pricing, then the ACCC could take action.
Joel Phibbs says at a minimum it's bad behaviour from the tech giant.
It's probably a poor approach from a customer experience perspective and from their goodwill.
Microsoft said the changes for its 84 million subscribers reflect extensive benefits and make the product more accessible. It said the company was committed to adhering to laws and regulations of every country, and existing subscribers can switch to other plans without Copilot features or AI credits. Australia's consumer watchdog, the ACCC, could not say whether it was investigating complaints about Microsoft, but it did say it could look into whether the terms of subscription contracts were unfair and whether there'd been false or misleading representations to customers. In the meantime, Marie has this message for Microsoft.
Do better. Don't take us for granted. Just because you've got our business doesn't mean that we're not real people and we aren't actually aware.
A warning the tech giant is facing from many customers since the price jump.
Tracking the whereabouts of friends and family has been good business for location technology company Life360. The company's shares surged on Friday to over $24 on a big lift in subscribers, with predictions it'll chalk up a full-year profit. But Life360 has been a controversial stock with concerns over privacy and misuse of the app by some customers. I spoke to Life360 CEO Chris Hulls from San Francisco. Chris Hulls, welcome to Close of Business.
Thanks for having me.
Your app is wildly popular, especially with families. How do you plan to continue growth both in customer base and revenue, especially when only a very small percentage of users pay for a subscription?
Sure. I'll take the first part first, which is how do we grow the user base? And if you look at families, it's not just husbands, wives, 2 kids and a dog. You have people of all life stages. So our emphasis has been on people with families with teens, but our goal as a company is to really broaden out, and that's already happening. And you can see it in our growth numbers. We don't have a single state where we're slowing down penetration. We have some regions where over 20% of phones running Life360, and we're now replicating that internationally. If you then look at how we're monetizing our service, as we expand to different life stages, we're going to launch different sets of services. And it's not just people, it's pets and it's things. We announced that we're doing pets this year, elder care next year. We are expanding our tile lineup to SOS functionality. We're improving our driving features, and we have advertising. Most of our customers, you mentioned, don't pay us. While that will go up, we can make money even for people who don't pay us directly. We call that indirect revenue. And given only about 1 in 8 US customers pay us, if we have 1/8 the per capita success with indirect, that will rival our subscription business. So we're very much in the early days there. We just announced the acquisition of Fantix, an AI-enabled platform that's going to help with targeting and attribution. So really, everything's been moving ahead at very quick speed.
Will you start charging all users soon?
It will be a very long time before we charge all users. I will actually go say we will never charge all users. At some point, we might get a little bit more aggressive on paywalls, but we're growing so quickly. The right move for us is to grow the user base and be the disruptor, not the disruptee. We think we can get to about 30% of people paying us without major changes. Just over time, more people pay as we launch things like pet tracking, elder care, as our membership gets more known for the broader set of offerings. We think that will happen. You have companies like Spotify with 50%, but we're committed to the free customer. It is our growth engine. And because we have this really rich data that we can monetize, first-party location data is exceedingly rare. These free users are very valuable to us as well as the people who pay.
You've just announced you've acquired a new AI ad tech platform. How important is advertising for your revenue?
It's very important for our long-term plans because, as mentioned, most of our customers don't pay us, and they probably always won't. But if you look at what we have, we can target very specific life events and behaviors that correlate with purchasing intent. So as an example, we have a partnership with Uber now, where when someone lands at an airport, we'll offer them to get a ride. To a customer, that doesn't feel like an ad. It feels like something that's actually helping them, because if you don't have Uber or something on your phone, one click, you're good to go. Or if you already have a ride-sharing service, it's just a seamless way to get into that app and get the car home. And it happens because we have that real-time location information that others don't.
There have been safety concerns raised regarding the use of your app by some people for stalking. How are you addressing that?
So we are a very, very transparent app. We do not let people stealthily put Life360 on someone else's phone. We are what we're called noisy. You get ongoing alerts when someone uses the product. We do not market it for stalking. We really are a daily life tool. We have had hundreds of millions of downloads, so of course, laws of large numbers. We've seen bad things happen, but it's an exceedingly rare event. And in the rare cases where someone is being used with the app inappropriately, we have a resources page to help them. And we are the first to say you should only use Life360 if you feel comfortable with people asking you to use it.
How concerned are you about the lawsuit alleging Life360 sold users' location data without their permission, and how do you plan to defend that?
We didn't do that, so it's going to be an easy one for us to win. People take shots at us, which happens when you become successful.
Are you worried about competition from similar apps and built-in tracking features in iPhones and Android phones, and how will you set yourself apart from those?
Sure. So we always watch competition. We are in a competitive market and people are coming around to the power of location. So when you look at the big guys, there's Apple. Historically, they actually have helped us quite a bit in the sense that they popularized the category when others weren't aware of it. And we actually have higher penetration in regions with significant iOS usage. So at some point that will change, and it's on us to innovate. And our focus is on families, and that's something that Apple's not doing. It's something that Google's not doing. So I'm actually more worried about smaller upstarts, people that can come more orthogonally, because the big guys really do try to be more a lowest common denominator platform. And so by having that focus on families, by really focus on product innovation, by keeping the core experience free, I really believe that we can out-execute them, and we're solving a different problem because, again, it's all about families. We're not just a generic location sharing app.
Chris Hulls, thank you for speaking to the program.
Thank you.
Wall Street closed in on the worst week in 6 months as US consumers tightened their belts on persistent inflation worries. And that's all the local markets track lower. The ASX 200 off around 1.5%. The All Ords finishing the trading week down around 1.8%. I spoke to the head of client coverage for FTSE Russell, Julia Lee, to wrap up the week. Julia Lee, welcome to Close of Business.
Great to be here, Nadia.
So reporting season is wrapping up. How have the markets responded?
This is a really important one for investors, and that's because the Australian share market has been trading at historically high levels. And when it's at those levels, you really need to see an uplift in outlook to keep those gains going. And if we have a look across the month of February, unfortunately, we have seen the Australian share market down by almost 4%. Looking across the sectors, we have seen losses across almost every single sector. The worst has been tech, down by around about 10%, but the healthcare space also down by 8%, and we've seen losses of around about 5% in the financial as well as the energy space. If investors were looking for somewhere to hide, it has been in some of those traditional defensive areas like utilities, which has done fairly well, and staples, which has also managed gains. But some big performances for the month of February. We've seen A2 Milk up a huge 35% on the back of better than expected earnings. But on the flip side, we've seen Viva Energy down about 32% in 1 month, and that's as its acquisition of convenience stores hasn't quite worked out as investors have hoped.
Heading over to the US, the tech correction has been another big story. What is behind Nvidia's decline, and is it part of a bigger pullback?
Well, we know how much earnings is important for share price action, and Nvidia seems to have ticked all the boxes. We saw a result which was better than expected. The outlook also looking strong, with Nvidia predicting that revenue will rise by 65%. But I think this is a case where Nvidia might be a victim of its own success. Growth of 65% is great, but when you've delivered triple-digit growth in the past, then investors expect to see a blowout result. So unfortunately, despite the very good result, the strong outlook, we've seen Nvidia shares trading lower.
Star Entertainment looks like it's down to its last throw of the dice. Where do you see that going?
Well, on Friday, half-year numbers were due, and with it a whole checklist of conditions to keep it as a going concern. It does look like it's still looking for a white knight to come in with a liquidity deal at this stage, so it really does need to see that capital injection. One of the issues is that secured loan holders, creditors, have about $430 million in loans, and they haven't been able to come to an agreement as of now to try and get that liquidity injection. So watching out for 1, possibly 2 liquidity proposals, and the company also is still due to release its half-year numbers.
Dan Murphy's owner, Endeavour Group, reported its earnings today, and its share price was down with a drop in profit. What's behind that? Is it to do with the broader economic conditions at the moment?
We're still seeing earnings trickling in, and if we have a look at Endeavour Group, I think it's an interesting one. It owns Dan Murphy's, and traditionally this period, the 6 months, is one of the strongest because it's leading into Christmas. But we have seen not only revenue down lower, earnings down lower, but also profit down lower, and the dividend's been cut by 12% to 12.5 cents for its interim dividend. There are a number of reasons. First of all, we have seen a pretty subdued consumer. Not only are mortgage repayments high because of interest rates, but inflation has really been hurting household budgets. But secondly, if we have a look across December, it's one of its most important months of the year. It's leading up to Christmas, and liquor and alcohol sales is usually relatively high. But in that period, there was a 17-day strike which hit Woolworths warehouses, and Endeavour and Woolworths actually share some logistics and warehouses. So Endeavour has been hit by that, and of course, longer term structurally, we're becoming a lot more aware about the health implications of alcohol drinking, and as a consequence we have seen non-alcoholic beverage sales rising, so just looking to see whether that has an impact here in Australia as well.
That'll be an interesting one to watch. Julia Lee, thank you for speaking to the program.
Thanks, Nadia.
Donald Trump's assault on diversity programs in the US has seen some companies pulling back on their quotas. The loss of hard-won gains in equity and inclusion comes as new data reveals when it comes to securing capital for startups, the vast majority of funding is landed by men. Here's Nassim Kadem again.
Entrepreneur Jessica Box knows just how hard it can be for women-led businesses to secure funding.
Hey, it's Jess from Match here. I'm happy to share a bit more about why we started the business and then go a little bit into why we're raising capital.
She's managed to obtain $500,000 for her app so far, but needs to tap investors for more as the company grows.
You know when you're walking into a room that the likelihood from a percentage point, all the statistics is stacked against you.
In 2024, just 2% of $4 billion raised in Australia went to all female-founded firms, and about 15% of investments went to startups with at least one woman in the founding team.
We haven't moved the needle as quickly as we want to.
Kate Glazebrook is looking at how one of Australia's largest venture capital funds can back more female-led startups.
We're instead looking at, is there spark for this founder? We talk in Blackbird about wanting to invest in wild hearts with the wildest of ideas right at the beginning.
So what do you think that means from a commercial opportunity perspective?
Others are also changing their approach. Venture capitalist Rachel Yang says much of the problem stems from gender imbalances within investment teams.
It's really disheartening and disappointing. And in recent times, particularly in the venture capital space, with the stats that are out there, it feels like we're taking 2 steps back before we can take a step forward.
She wants investors to change the way they measure the progress of their investments.
I think the startups of today are actually the big corporates of tomorrow. So if we're not having this conversation now and supporting startups that are diverse now, then we're just perpetuating an endless cycle of corporates that continue to have and demonstrate bad behaviour in relation to gender equity.
The debate comes as US President Donald Trump recently issued an executive order to scrap workplace diversity and inclusion policies. The Republicans argue quotas promote discrimination. In response to Trump's order, global companies, including Google and Accenture, have now abandoned their diversity policies. Despite that, there are calls for Australia to follow in California's footsteps and introduce mandatory diversity reporting like the US state did in 2023.
This is going to really highlight who, in the ecosystem are making the investments into gender diverse and ethical diverse businesses. And absolutely that should be in Australia as well. If it's being hidden, how do we expect these organisations to change?
Ms Bock says for the next round of funding, she intends to knock on the doors of venture capital firms in Silicon Valley.
Think don't take no for an answer. I was not prepared for how many no's, and I've had a reasonable amount of experience in the space, and I think it would be easy to walk away, and so much of startup life in general at all of these stages is just sticking it out and staying in the game for longer.
A long game that's becoming tiring for many women looking to start their own business.
And that's all from Close of Business. I'm Nadia Daly. Thanks for watching.